it is just not possible for us to continue to meet the needs of our customers who are mostly now, all transition towards their mobile phones and towards internet or computers, where they, you don't hardly ever see now those lines that we used to have outside banks, just to make utility payments. There are lots of shifts in behaviors that have taken place, and we have to be aligned with those behaviors, those shifting behaviors. The customer care is not going to go out of its way and undertake a transaction on the computer, on the internet, on the mobile, and then undertake the payments on separately by lining up in outside a bank. So the entire ecosystem is going to be integrated, and we have to continue to come up with new ways to be part of that journey, and in a very transparent way, because where there was this focal sort of the point, that's the nucleus of every transaction, where there was a financial institution sitting out there. And today the customer is actually less worried about who that the transaction is going via. They're more worried, interested in convenience, safety, and reliability, the credibility of the vendors where they're undertaking buying the merchandise or the service from. So the direct connection that you have with the service provider or the merchandise provider to the customer, and you have to seamlessly transpose yourself in the middle of all that. So the banks will have to shift. No one is going to come to our branches and in due course the numbers are coming down significantly, and it is imperative for the long-term sort of relevance of the industry that we align ourselves and position ourselves to be part of that journey. Data is there. I think that the challenge that you have is there are two elements to that. One, data in the form where it can be used. If I go back, we don't have to go outside. If I just look at my bank, I have most of my clients, many of my clients are with us. I have 50 years of their history, where they started from, where they are today, how did they go through that journey. If I want to understand just a customer's journey, I have that data sitting across my portfolio. I have credit history of a very large segment of this country. Similarly, if you go to the rest of the banks, there's a huge reserve of data that we are sitting on. One of the things that we had done as a part of the data lake project itself was to streamline and put those into buckets where we can start using that more effectively, and integrating that into all that data that is coming in. It's going into verticals and into those buckets, and also for us to effectively use that for our decision making. So this is the second element. How do you use that data which is available? And there is not going to be a choice. You are getting into a stage where decisions are going to get really fast. Customers are not going to wait for you for months for the credit decisions. They will have choices. So the decision needs to get made very fast. And that cannot be made until we start effectively using that data. Plus, you just cannot walk away from reality. IFRS is a reality. You can't have ECL calculations or the effectiveness of your entire credit loss projections unless you have an effective risk rating models, and those have to be statistically driven. Go back to the question that you had on the data. When I look at the credit history of my obligors, of my portfolios, I have the statistical sort of data, empirical data available across the entire spectrum of my portfolio, and I have to find the probabilities of default. I'll not get into technicalities of that, But the fact is, you have to have an effective risk rating models which is statistically driven based on the empirical data which is residing in the banks. So banks will have to have robust risk rating models, and not just risk rating models, which are it's not static. There is a validation process which has to be put in place. You have to go back and again ensure on an ongoing basis that those are relevant, those are effective. So I think the sooner this realization sort of gets embedded in the minds of our risk managers as well as across the industry, uh, the more useful it is going to be, because the resilience and the effectiveness of the entire IFRS regime is basically rooted in an effective risk rating model. It is changing. I think we'll be really fooling ourselves if we think the skill sets that we came up with and we learned over the years are going to be the skill sets that are going to be effective in the future. Risk management is going to shift, and banking industry is going to shift. You are going to become totally irrelevant if you don't shift and become a part of the consumer purchase journey. You have to be more sort of invisible, because the customer is less interested in the bank who is providing that money. Huge challenge. That's the one element where we were very lucky to be slightly ahead of the cycle. We had identified that as part of our journey, as we embarked on the digital journey. We have to have those sort of safeguards, and we went ahead with uh, getting a system that allows us to monitor on a real time basis the transactional activities of our customers. You cannot manage that purely from on the basis of the legacy control systems that we have. The velocity of those transactions is so fast, and the volumes are so humongous that it's just not possible to continue to apply the strategies, the mitigation strategies, and the controls that we had for our typical conventional banking ecosystem. So so that actually requires slightly, a differentiated approach where you have to basically go out and start managing the risk at the time of origination. So, I need to know where possibly I can, get major onslaught of, external activities, and I create those layers and layers and layers of those securities. Uh, as I look at the rest of the ecosystem around us, I think that this is a consistent war, continuous war between between us, the banks, and those elements, rogue elements in the environment, who continue to challenge us to think forward. In terms of the environment, I think the biggest change that we've seen in the last 12 odd months is uh, the the continued high interest rate has created some leverages in the balance sheets of the customers, and it is critical from long-term sustainability of the sectors as well as the obligors that effective mitigation steps are taken. Now, there are certain sectors that have the capacity to pass on the impact of deval. They have the capacity also to pass on the impact of higher interest rates. But there are various other sectors, which will continue to be under stress. There are also some early signs of demand compression that we have seen. There has been slowdown in certain sectors of the economy. Look at construction, for example, um, uh, which also leads to some compression on demand from cement side, steel side. Similarly, if we look at the offtake of automobiles in the country, that has significantly reduced. So, that obviously leads to some impact. When there's a top line impact, there is going to be some EBITDA and some net profitability, and the cash flow impact that we have seen. So I think in the last 12 odd months, there has been a lot of focus from the banks on the credit side. We haven't seen so far large scale defaults in the sector, but having said that, this is one area which we are very keenly looking at. The reason you aren't seeing any large defaults is because a lot of banks have learned from the mistakes of the past and understand that it is critical that the wheel of economy and the churn within their portfolio continues to move. It is not possible to get any money out of a closed factory. It is important for you to understand that there are going to be ups and downs, and you have to stay with the long-term survivors within the sectors.